Don't let health insurance be the reason that you aren't retiring early. Based upon your modified adjusted gross income, the federal government will actually subsidize a portion and sometimes all of your health insurance premiums on what you buy through the Affordable Care Act marketplace. The federal government has told you and conditioned you to say, hey, we don't retire until 65 when we get Medicare. My father-in-law said his advisor told him plan for $28,000 a year in health insurance costs. We believe that there are too many ways to access health insurance in early retirement that it shouldn't be a blocker.
You're tuned in to the Matchpoint podcast, How to Win the Money Game. I'm your host, Thomas Cook, financial planner and founder of Retire to Teleco, a wealth management firm in Knoxville, Tennessee. And together, we'll navigate the financial court of life to help you maximize your wealth and minimize taxes in retirement. Today on the podcast, we are lucky to have Cole Cravens join us. He is the co-founder and head of growth of Move Health, which is a really awesome healthcare planning firm that is bridging the gap of good financial planning and good healthcare planning to make sure that retirement's not being delayed just for something you didn't know about healthcare. I actually connected with Cole on LinkedIn through a different advisor. Was super excited because Cole is the first person that I've seen of his kind that strictly works with fee-only financial advisors on the healthcare side of things. So I was super stoked to meet him. So anyways, Cole, why don't you dive in and give us a little bit more about you and your story?
Yeah, of course. Appreciate that. Thomas, thanks for having me. Like I said, I'll have to make it down to Tennessee to see you at some point. We're not too far away, but I'm in Evansville, Indiana. My name is Cole Craven. I like Thomas said, one of the co-founders of Move Health here. I have here in Evansville my wife and our one son. He's a 3-year-old, and we've got another one on the way, and so we're getting ready to experience that. I know, Thomas, you've got 2, and so it's a unique experience. So if you've had a good experience going from 1 to 2, let me know. But all of that to be said, we live here in Evansville. We have an office here, which is where I'm at today, the Move Health office. And we started Move Health to solve a pretty unique problem. There's a lot of people, millions of Americans, that want to retire early, and they're working with a financial planner, and their financial planner is saying, "Go ahead, you've got the funds to do so, retire," but you got to figure out health insurance, right? And so that's what we kind of set out to do with Move Health. Is we've got a team of health plan advisors that help clients of financial advisors to work through that strategy for health insurance in early retirement being pre-65, as well as the transition to Medicare. So hopefully that's a good intro. I like to say that I'm a husband, I'm a dad, and I'm a professional grace receiver. So my wife requires a lot of grace to deal with me, but it's all good. So.
Yeah, and something this audience may appreciate, you're actually a baseball fan, so we connected around the time that the College World Series was happening, and it just so happens that my school, the University of Tennessee, was playing your school, Evansville.
That's right.
You would just want to remind us how that went? Was it?
University of Evansville, the Purple Aces, underdog, Cinderella story, made it to the Super Regionals. Yeah. Actually handed University of Tennessee their first loss at home by more than 10 runs in like a decade. So they ended up losing the series, but it's all good. It was a fun run. It was cool to see the guys come back to town. They were like hometown heroes. UE's a really small school, so it was cool to see them kind of slay a giant once at least. So.
Quick reminder, though, what we're about to cover today is just high-level overview. If you guys want more information specific to your situation, I would definitely recommend reaching out to Cole. And at the end of the episode, we'll make sure that he shares his information with us, and we'll leave it in the show notes. A lot of people that I talk to, especially pre-retirement, thinking of this demographic, and by pre-retirement, I mean somebody who wants to retire before age 65. One of their top concerns, if it's not the top, it is always part of the conversation, is what am I going to do about my health care? And they've heard that it's just super expensive. It really can be a reason that someone may drag out their retirement longer than they need to, just the concern of it. So I would love to hear your thoughts addressing this topic a little bit.
Yeah, so it really started the idea for Move Health. I've been in the health insurance and Medicare space for a long time, and I've always kind of bumped into financial advisors and like, hey, can you help my client with this? Can you help my client with this? And we're like, yeah, sure. But it was never a focus of ours. And then when we started really focusing in with Move Health, we said, okay, what's the sizing, right? So then we looked and we said, okay, there's 40 million Americans between the age of 55 and 64. It's a generation of people that have saved dollars through their employer and been diligent and all those things. And there's a lot of them that want to retire early but can't because of health insurance or the perceived idea of going and getting health insurance on your own, and for a variety of like myths and reasons they would believe that. And then it became very, very real to me. Like I mentioned, we have a 3-year-old where my in-laws, they wanted to retire to spend more time with their grandson. And as soon as my mother-in-law found out that we were pregnant, she quit her job. She said, "I'm supposed to be a full-time grandma. That's what I want to do." And she was 59 at that time. My father-in-law said, "Okay, I'm going to be a fast follow." He'd been a pharmacist for 30 some odd years. It's like, "I'm going to retire here shortly." Went and sat down with his financial advisor, and his advisor told him, plan for $28,000 a year in health insurance costs. Wow. And my father-in-law stopped right there and said, "Sorry, I don't hate my job that much. I'll keep working." And so he was prepared to continue working for 5 more years just to satisfy the need for health insurance coverage, because he assumed that it was going to be really expensive. And so we at Move Health believe that no one should delay retirement specifically around health insurance. There are reasons you should delay retirement, right? You don't have enough funds, whatever it might be. You're the expert in that, Thomas, not me. But we believe that there are too many ways to access health insurance in early retirement to that it shouldn't be a blocker. So.
Wow, 28,000. And the fact that he heard that and then it's like, I don't hate my job that much. That is, that's a great story. And unfortunately, we run into that a lot, actually. And I could dive deeper on that, but, just looking at some of the material that we wanted to cover today, is there, I had heard that you have had some interesting statistics around healthcare in retirement.
Yeah. Yep.
Do you want to share more about that?
Yeah, so this was from a Nationwide, the insurance carrier. It's not a carrier that we contract or work with, but Nationwide, the insurance carrier, they do a thing every single year that's the Healthcare in America Retirement Study, right? And so we could link to it in the show notes or whatever you want to do, Thomas, but there's some really staggering statistics that were a part of that, right? So 62% of Americans, that were in this early retiree segment are terrified. This is the quote: "Americans are terrified of what health insurance may do to their retirement plans," right? People don't understand it. We fear what we don't know. Beyond that, 60% don't understand their current health insurance coverage. It's like, I believe that everybody would benefit from understanding at a high level, like, what does my deductible count towards my maximum out of pocket? Do copays go into my maximum out of pocket? What is a copay? Why do I have to pay that? What's coinsurance? Like, there's a ton of information that people just don't know about their current insurance, whether that's through an employer or through, the Affordable Care Act marketplace or whatever it might be. I think everybody could benefit from education in that. But 60% of folks that were surveyed in this, and it was kind of that key 55 to 64 window of people, don't understand their current health coverage. I mean, I've sat in a room with a group of early retirees and said, "Who can tell me their deductible right now?" And less than 20% most often can say, like, "Oh, I confidently know what my deductible is and my network and all of those things." And so the other piece about this kind of 55 to 64 window, or this early retiree, doesn't even have to fit into that window, just pre-65 retiree, most of the time, this is the first time that they've ever had to buy health insurance coverage outside of a job, right? Most of the time it's, you get a job, you get 3 options through your employer or 1 option through your employer, and that's what you take because that's what's available, and you make it work, and you learn how to deal with that plan, and you learn that plan, you get comfortable with it. There's a lot of preconceived notions about, health insurance is going to be really expensive, or it's not going to cover my pre-existing conditions, or things along those lines. We'll get into that here in just a little bit, but there are staggering statistics. And Thomas, you being a financial planner and some of the stuff that you do, that it comes up with your clients. It's a big part of the conversation. And so, good on you for being forward thinking and wanting to tackle this head on. And though you don't understand it, maybe to the depth and degree that I do, it's important that you know it at a high level so you can guide your clients through the conversation, at least sharing with them like, hey, like, this doesn't need to be a boogeyman in your retirement plan.
100%. In fact, it's interesting to hear you say that a lot of pre-retirees aren't even aware of their current, healthcare situation inside of their employee plan. And as you're saying that, I'm just thinking, I've talked to a lot of people, and they just First, their employee benefit package is this 70-page document, and like, there's no
Right.
way they're reading all of that, and it covers so
Correct.
many things. But then
Yep.
it's like I'm going through like, the discovery process and helping people understand what their current financial reality is. I would say the most forgotten account is the health savings account. I
Yeah.
often
Yep.
find it much later. Or I have to ask specifically about it because people just forget that they even have it. It's just maybe set up through work, happening
Yep.
automatically, and so they may be totally underutilizing like the tax-free growth of a long-term strategy of a health savings account. But
Yeah.
yeah,
Exactly.
a lot to unpackage here. But I'm curious, how are you seeing most Americans access health insurance coverage currently?
Yeah, so it's a really good question. So, in America, we've kind of built this idea that most people will get health insurance coverage through their job. And so we put that burden on employers in America. Many times they're paying a portion of those premiums. And so 50% of the United States gets health insurance coverage through their job, right? So through their job or their spouse's job. So that's 50% of the United States gets it through a job. So a ton of people. There is, a small group of people, about 7 to 9%, depending on the year, that actually go totally uninsured, right? So we're kind of at that 60% mark at this point. 50% get it through a job, 7 to 9% go totally uninsured. 15% of the U.S. and continuing to grow are on Medicare, right? So Medicare is, a federal health insurance program, is written into law in the 1960s. There's Medicare Advantage, Medicare Supplement, Part D, Part A, B, C, and D, all of those things that go into Medicare. That's 15% of the U.S. access coverage through that way. 20% get coverage through Medicaid. Medicaid is low income, typically state-based, state-funded, insurance for individuals that fall beneath a certain income threshold. And then kind of this last grouping, growing as well, is folks that buy health insurance outside of a job, right? So these could be early retirees or 1099s or folks that are entrepreneurs, Thomas, like yourself, that have started your own business. You're accessing health insurance through, the Affordable Care Act marketplace or whatever it might be. We'll kind of get into those options here in a moment, but accessing those on your own, buying your own health insurance coverage is kind of that last 8 to 10% of the United States. And people go, well, that's not very many people. It's like, well, it's actually like 30 plus million Americans get their health insurance coverage outside of a job, not through Medicare and
Yeah.
Medicaid, et cetera. So,
Yeah, it's amazing when you break down a percentage to the actual number, you realize
Right.
just the gravity of that. And one
Correct.
thing you said, I actually didn't know that breakdown before you said it.
Yeah.
So it is interesting to me. And one thing I just wanted to add that could potentially help somebody listening to this podcast, that even if you are employed, that doesn't mean you have to use your employer's healthcare plan. And I'll just give you an example. I worked for a small business before launching my wealth management firm, and to use their plan was going to cost me over $1,000 a month, and I was able to find a much cheaper plan with the same deductible outside of it. And so a lot of times your employer can subsidize the plan, and it is reasonable to use the plan that they have available. But I just wanted to mention that, to not leave that stone unturned, just in case
Yeah.
there is an alternative that could.
And
get
a
you
lot of
the same
times folks
coverage.
just, yeah, 100%. A lot of times folks assume that, oh, it's my employer plan, it's going to be really good, right? That's
Yeah.
sometimes a myth you can tell yourself. Employers are managing costs as well, and so they're looking at ways that they can manage those costs. And sometimes that's, like you mentioned, they'll subsidize the employee, but then when you go to add family members to it, it can get really expensive. Things along those lines.
That's
So
what happened in my
always-
case, right?
Yeah, always worth comparing and contrasting. And health insurance for a small business is hard. Right, it's a hard thing to offer to your team because it can be it's a big line item if you want to subsidize a significant portion of it. So something to think about. And yes, good call out. You can certainly look, to other options or alternatives to just your employer coverage. You don't have to take it.
Yeah, thank you. So diving into maybe what are the options, and we've kind of talked on them, but I'm just curious. There's really there's several that come to my mind, but what comes to your mind as far as options for healthcare
Yep.
for these early retirees?
Yeah, so in the early retiree segment, and I will say this, like this is in no particular order of direction that I think someone should go or whatever. It's unique, just like financial planning in the health insurance space. There's a lot of times where we say it depends, right? What's the
Yeah.
best plan for me? Well, it really depends. There's a lot of variables
Yeah.
that go into
Great
why we would
answer.
help someone make a decision. And people hate that, but at the same point, once they go through a process, they're like, oh, now I understand why it's so highly variable. Which is also a good reason as we talk about employer plans and things along those lines to really look at it with a fine-tooth comb and make certain that it's meeting your needs effectively. But the 5 main options for early retirees, folks that are leaving their job, don't have coverage, through their job any longer. The first option is going to be, we're going to talk about it, it's called COBRA, right? COBRA is not the snake, but we're talking about the law, right? So COBRA is a law that was written in the 80s that says you can continue your employer benefits, given that you have a certain threshold of employees at your organization. You can keep your employer benefits, but the kicker is the employer no longer contributes to that plan or subsidizes any portion of the plan for you. And so you're paying 100% of the premium, which can be very expensive. And then actually to add insult to injury on the COBRA side of things, there's actually also a 2% administration fee that is added on top of it. So you're paying 102% of what you would pay. So COBRA is expensive, but the good news about COBRA is that your deductible doesn't reset. And so as we think about it this time of year, if you have someone that is, already maxed a deductible, we're recording this in August. It's the 8th month out of the year. If someone has already maxed a deductible, hit their maximum out of pocket, and they're, kind of riding at 100-0 coverage on the health insurance, sometimes the juice is worth the squeeze to pay the exorbitant premium to not have that deductible reset. So that's one thing you consider with COBRA. Typically the most expensive option available, but you get to keep the coverage that you're on. You're familiar with it. You know what doctors you can see, et cetera. Another option is term major medical or short-term major medical, off marketplace, sometimes they would call it. These would be, health insurance that might have some underwriting questions. They're going to look at height, weight, prescription drugs that you take. Typically, they're not going to cover things like pre-existing conditions, maternity, things along those lines. Those would be like off marketplace, short-term major medical. And there's some, legislation that has come through that actually starts in September of this year that is reducing the amount of time that you can carry one of those policies in a calendar year. And so those are kind of going by the wayside. Another option to always review is if you've worked for a large employer or a union or things along those lines, look at what your retiree health benefits are. Sometimes if you've worked for, and I say large employer because those are most of the time the people that are offering them, will, cover or subsidize at the current rate your health insurance until you hit age 65. Some go 65 and beyond. So just have a full understanding of what your employer offers to you to make certain you can leverage that. Sometimes what I will say is those plans are getting skinnier and skinnier. And if you're on the retiree plan, sometimes that's not the same plan that the employer plan that you've been used to is. Sometimes those are different. So always worth checking into, always worth understanding what the option is there.
Just quick thought that here in East Tennessee, there is a large employer, the National Lab. We get people that move from all over the country, and I would put them in this category. Like they are generous with their retiree benefits. So that is definitely something like a stone that you would not want to leave unturned for sure.
Yeah,
so sorry,
always
continue.
Always worth diving into it. So we've talked about COBRA, we've talked about short-term major medical, we've talked about retiree health plans. Another option would be healthcare sharing programs, right? And just like anything, just know what you are getting into. We help some folks with healthcare sharing programs, not a fit for everybody. Most of the time they have a faith-based component to them, and they are not traditional insurance. And sometimes that wigs people out and they get freaked out by it. And that's totally normal. And this would be considered an alternative to health insurance. And many times, like I said, they have a faith-based component. They're on a rise in popularity just because they are typically significantly less expensive. But they have some unique things, guidelines, member bylaws, things along those lines that you need to, agree to and then abide by, and varying levels of participation on what you actually need to do as far as to be a member of a healthcare sharing program. There are some that act very, very similar to insurance, and there are some where you are cutting a check to a person, right, helping to pay for their health insurance costs. So there's varying widely. Some big names that are kind of out there would be things like MediShares. Probably they're the largest and oldest in the healthcare sharing space. And we have seen people use this with great success, and that's been something that can be utilized. So,
Yeah,
okay, so we talked
just
about, yeah,
one thought there. Sorry, just pulling from experience. When I talk to people about this option, they're generally in two fields, and you couldn't be more polar opposite. Like they
correct.
either extremely love it or they extremely hate it, and it's
Yep,
so fascinating to hear their perspective. The people that love it are like can't even believe that it works the way that it does, and they've had a good experience, feel like they've underpaid what they would have paid.
sure,
The people that hate it, a lot of it, and you see this a lot in the reviews, is, well, exactly what you said. It's not actually insurance. And
yep,
so if something happened, like you broke your leg while you were on this plan, but then you switch to something else and you stop sharing in other people's payments, well, they're not
sure,
going to go retroactively pay for your broken leg, even though you had their program when you broke your leg. Like you have to be
sure.
like it's an ongoing thing. Like that is a very distinct difference between insurance. Where even if I change insurance, if I was covered with an insurance company, they would still have to cover that broken leg. Anyway, so just two fields. I thought that was
Yeah, 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 for sure. And I think
kind of
the other
interesting.
thing is it's just being with any type of insurance, right? It's going into it eyes wide open, knowing what it does do and what it doesn't do. And I think a lot of times people will see a lower price tag on a healthcare sharing program, go, I'm going there, and then get frustrated when their
Yes.
prescription drugs aren't covered at a certain rate or not shared in or
Yeah.
whatever it might be. And it's sometimes it's just they didn't understand fully what it was. And so this is not an infomercial for Move Health, but anytime that we are helping guide someone to make that decision, particularly, we're helping them to understand exactly how it works so that they know, they know what it is. And like once again, not a fit for everybody, but it's an arrow to have in the quiver. The last
Awesome.
one, so we've talked about Cobra, we've talked about short term, we've talked about retiree health benefits, healthcare sharing programs. The fifth option that we see a lot of early retirees working their way into is the Affordable Care Act marketplace with advanced premium tax credits. And so we're going to do a little bit of a deeper dive on this here in just a moment, but I think that is the one that we are seeing the most adoption with. There's some control that you can actually have over your health insurance costs via advanced premium tax credits on the marketplace, and how those work with relation to your modified adjusted gross income. And we're throwing around a lot of different tax phrases and things along those lines right now, but you actually can have some control over what your health insurance costs may look like in early retirement with the Affordable Care Act marketplace. And so maybe we should do a little bit of a double click there, Thomas, if you're ready to transition to that portion of the conversation.
Yeah, happy to. In fact, this is an area that I feel like we can collaborate well as professionals, because
Yep.
from our side, we do a lot of the tax planning around this, where especially if they have, a large portion of pre-retirees have a lot of their money tied into their 401k, so this
Yep.
pre-tax bucket. But if they've done some planning before this point, they may have some Roth money or money in a taxable account. And so they have this
Yep.
tax diversification that lets us really get tactical
Yep.
about their income in these years before Medicare, where we can maybe even get them this premium tax credit for what they're doing. I don't know. I know you probably have some thoughts around that from your perspective. Can you dive
For
a little
sure.
bit deeper on that?
Yeah, of course. So I think it's probably important to kind of like think about what the Affordable Care Act is. We hear the ACA marketplace, you hear Obamacare, you hear Biden care, Trump care, whatever it might be. You've heard a president's name attached to care, and most of the time that is referencing the Affordable Care Act marketplace. But I think backing up even
Right.
further, what the Affordable Care Act, or the ACA, as you might hear me reference it as, is the Affordable Care Act was the largest piece of healthcare legislation that's ever been passed. Bar none, full stop. It was huge. If you remember 2010 when it was passed, there was a phrase. It was a big freaking deal. Biden leaned over to Obama when it was passed and said that. I don't know if he said freaking or not, but whatever. He leaned over and said, "This is a BFD," and because
Yeah.
it was a really big deal. It affected how doctors operated. It affected how you were billed medically. It affected a lot of things in healthcare. But one of the biggest changes and one of the biggest things that you saw come from it was the Affordable Care Act marketplace. And so for health insurance specifically, it did one really big important thing: is it made health insurance guaranteed issue. And so if you buy health insurance coverage through the Affordable Care Act marketplace, it is guaranteed issue. And that means if you have a pre-existing condition, if you are undergoing current cancer treatment, if you have broken your leg and need health insurance, you can get it, given that you have a qualifying life event or a special enrollment period, right? Or you're in the open enrollment period. Always need to qualify it with that. But pre-existing conditions are no longer a concern. There are a ton of early retirees that are under the preconceived notion that health insurance is still something you have to undergo underwriting for, and you have to be in good health or within a certain height weight matrix to get health insurance. They're nervous they're going to be rated up or denied coverage based upon those things. That has not been the case since 2014 when the marketplace started. And so if you are an early retiree and you are concerned about health insurance and you're saying, I can't get it because I had a heart attack 3 years ago, that is not the case any longer. You can get health insurance coverage through the Affordable Care Act, through the Affordable Care Act marketplace or your state exchange. So all of that to be said, when the Affordable Care Act marketplace was put into action, and you are familiar enough with insurance to know that there are these people called actuaries that work at those places. And so if an insurance carrier heard, hey, you have to give health insurance to everybody regardless of their health status, well, guess what happens? The actuaries go, oh my gosh, we need to put everybody in the highest risk bucket. So on January 1st, 2014, health insurance premiums went up 300%. Wow. Overnight, because everybody gets health insurance coverage through the Affordable Care Act marketplace. Now, the Obama administration, as they were writing this into law, they knew that was going to happen, and so they put these things into play called advanced premium tax credits. And advanced premium tax credits say, based upon your modified adjusted gross income for the current year, so if we're looking at 2024 and someone's needing coverage that starts in September, we're saying, what's your 2024 total income picture look like? Based upon your modified adjusted gross income, the federal government will actually subsidize a portion and sometimes all of your health insurance premiums on what you buy through the Affordable Care Act marketplace. Now, the last caveat that I'll add to this is you cannot be eligible for employer coverage. So that's through a spouse or through your job to take advantage of these. You also can't have Medicare or Medicaid to take advantage of these advanced premium tax credits. You have to be someone that's buying health insurance coverage outside of a job, no access to Medicare or Medicaid either to take advantage of them. But like you mentioned, Thomas, there's a ton of ways to kind of get really tactical with the health insurance costs and being able to say, okay, if we take from taxable account or Roth dollars, those aren't contributing to your modified adjusted gross income. And so we have multimillionaires that we work with that come to us that are clients of financial advisors that have a tax diverse portfolio and can say, hey, health insurance, we don't need to worry about it because we're going to take from these sources and we are going to show that you make $29,000 a year as a couple. Now, their take home, if you think about what they're actually living on, might be $129,000, but that's where they're taking those dollars from. And so hopefully that gives a good kind of primer for the conversation there.
Yeah, that's and you'd be surprised when we go through this with pre-retirees. They almost are puzzled. They like that can't be right. Like they almost, I don't know if guilt or shame is the right word, but it almost looks like that when they're like, I have all this money and yet I'm getting subsidized healthcare. Like something about this is wrong. But it really just goes to show the value of working with a planner and knowing how the system's set up. It's not a loophole. It's how the system is. And so just learning how to play within the system, the framework of the current system. So I can kind of do I'll do a callback, right? I think that's what they call it in the big leagues is, a callback to the beginning of the conversation where we talked about my in-laws, right? They were told to expect to pay $28,000 a year in health insurance. And, so my father-in-law came to me and he's like, Cole, is this right? And I was like, well, no, let's talk about where your income is coming from. Let's talk about the strategy that you've got in place. I'm not a financial planner, but I was like, what's your modified adjusted gross income? And so we went back and we got that. Turns out they're spending less than $8,000 a year on their health insurance because of these advanced premium tax credits. And so we're not talking about save 15% by switching to Geico. Using these tax credits, leveraging them effectively is sometimes a $20,000 or $30,000 swing, and we see it almost every day here at Move. We had one yesterday where it was a client enrolled themselves into marketplace coverage. They had a little bit of a slip up in how they did it themselves. We looked at their application. We're like, hey, we need to put these tax credits into play, and it ended up being a $26,000 move for them. Frees up a little bit of cash flow throughout the year for sure. If you're giving back a little over $2,000 a month, and so super impactful way to plan for retirement and health insurance costs using those advanced. That was cool. I love the callback to that personal example. And what I love more about not even just the $20,000 a year difference of what they were originally told and what the reality was, is if you put that in a time perspective, like
Right.
that was 5 years earlier retirement than he had thought. Like, what's the ROI on that? And I'm big on that. Like, if you go to my website, my whole theme is maximize life, minimize taxes in retirement. And part of that is because, in my personal experience, my grandpa worked 40 years for a company, had a pension, retired, got a heart attack, got an infection of the bloodstream, and died. Like he died in his 60s. He died too young. That's not going to be everyone's example. A lot of people can live in their till their 90s, 100 or whatever. But the thing is, we just don't know. So it's like living life on your terms as soon as you can. Like, how do you put an ROI on that? Like that's the value of this.
And I think
sure.
something else that's super interesting is, we think about, okay, Social Security, kicks in at 62, or you can kick it in at 62, right? There's a different by generation what full retirement age looks like. But what is everybody's retirement planning software default as the retirement age? 65, right? And so it's, as you think about it as an advisor or as a person, the federal government has told you and conditioned you to say, hey, we don't retire until 65 when we get Medicare. Right? So you saying at 59, hey, I'm concerned about health insurance is totally valid. Like that makes sense because we've been conditioned to think that way. Everything that we do, our retirement age is surrounding when we get federal health insurance. And so it's a key thing to think about. And so those advanced premium tax credits on the marketplace, there's no return on investment like having years back. You can always spend more money. You can't spend more time. You can't get more time. And so that's a great example as well, Thomas.
Yeah, I love another quote comes to mind as you say that. Healthy people have 1,000 wishes. Sick people have one.
Yep.
Right. Think about that for a second. Like, and that's why I think early retirement is becoming more of a trend. Is people are realizing they want to enjoy their money while they still have the health to do it.
Yep.
And so yeah, this is incredibly helpful. You have taught me even things about healthcare for pre-retirees. So I'm super grateful for you coming in. I had no idea that overnight healthcare premiums jumped up 300%, and that's why we got the premium tax credit.
That's exactly why.
Super insightful.
I think one last thing, if I can give one last little nudge on the ACA side of things, was 2021, post or mid-COVID, I should say, as we all remember fondly that era of life where we wore masks and did all the things and sanitized all like crazy. There was a bill that came out. It's called the American Rescue Plan Act. And the American Rescue Plan Act did a couple things to the Affordable Care Act specifically. One of the big things that it did is it used to be able to qualify for those tax credits on the marketplace, you had to stay under a certain income threshold. And at that point, for a early retiree couple, that was something like $80,000 in modified adjusted gross income. The American Rescue Plan Act came in and said, hey, guess what? That income cliff where you have to stay underneath, because if you went over that 80,000 modified adjusted gross income number, you were paying full price for a plan on the marketplace, which was anywhere from $900 to $2,500, depending on the plan selection that you chose. If you went above $80,000. So we would help people in those days manage their income beneath that, alongside their advisor. But now the income cliff is gone. So they blew the lid off of that. There's no income ceiling. So now Affordable Care Act tax credits, advanced premium tax credits in the marketplace act like a sliding scale. So the higher your modified adjusted gross income becomes, the lower your subsidy or your advanced premium tax credit becomes. Vice versa, if you can drive your modified adjusted gross income down, you can actually qualify for more of those tax credits. But now there's a cap at 8.5% of modified adjusted gross income is your expected level of income contribution for the silver middle of the road plan available in your area. And so that's the same thing. If someone stops you in the grocery store, Thomas, what's the grocery store chain where you're at? Is it Piggly Wiggly or is it Buc-ee's? What is it down that way?
Well, we just got Buc-ee's, which is a huge hit from a gas station, bathroom point of view. But out here, Kroger's probably the local one. Ingles, those are probably the public.
I use this example all the time where I'm like, okay, somebody stops you in the Kroger parking lot or the ice cream aisle, and they say, okay, Thomas, I'm ready to retire. What's my health insurance cost going to look like? And we can say to a financial advisor, we say, well, if you're enacting modified adjusted gross income of $100,000 for your client, they're going to have to pay roughly 8.5% of that for their premiums, right? So you can go, plan for about $8,500 a year in health insurance premiums in retirement, and go talk to Move Health about what your deductible and copays and maximum out of pocket and those things are. But being able to give your clients saying, okay, 8.5% is kind of the bar. There are plans that are more expensive than that. There are plans that are less expensive than that. And as you drive your modified adjusted gross income down, your expected income contribution actually lessens with it. So you can get to a point where your advanced premium tax credit you receive actually outweighs the cost of a plan. And so you get people that are, once again, multi-millionaires that are paying $0 a month for really incredible health insurance coverage. And so there's a lot of ways to do it. And you don't want to over optimize for health insurance costs at the expense of big RMDs in the future, things along those lines. But at the same point, there is room to massage income if you have the opportunity and the flexibility to do so. And so that's something we help advisors with and clients with a lot.
That is really helpful. And I guess one last example I'll throw in. I've seen, and we've helped a lot of clients with this Affordable Care Act, if they have, like I said, that money outside of a 401k, where a lot of times if they sold an investment property, they sold a business, or they were just diligent savers and they were saving above and beyond the contribution limits of their 401k, well, they have this taxable money. What I've seen is that we've been able to do Roth conversions for them to generate the income they need to get between that 100 and 400% of the poverty level and qualify for these premium tax credits. So not only are they getting the subsidized the subsidized healthcare through the premium tax credit, they're also getting money out at a super low tax rate and putting it into an after-tax bucket that's going to grow tax-free for the rest of their life and at least 10 more years of whoever inherits that money. So a huge planning opportunity for pre-retirees from a tax planning standpoint, from a healthcare planning standpoint. Again, not a reason to delay your retirement. It is definitely a reason to have that conversation. I think the earlier, the better. Is there any age that you would say is an ideal time to start that conversation?
Yeah, I mean, it's not really an ideal age per se, but
anything too early.
Yeah. I mean, the thing is, health insurance plans are released on an annual basis and costs are set on an annual basis. And so if we're talking to someone who's thinking about retirement in 3 years, at Move Health, we're going to do our level best. We'll give you some ballpark numbers, but we will qualify and say these are ballpark numbers. Things are subject to change. Now that there's a unique combination of government and health insurance, and there's an election coming up, and there's potential changes and things like that. We keep our clients obviously in the loop on those things, but there's change that can happen, right? So just with like a financial plan, we don't know exactly what the market's going to do. We've got a pretty good idea, but we will, if we're a couple years off, we'll say it's ballpark. Typically, we like to start the conversation if someone's got, hey, I'm retiring on December 1st. We want to start that conversation 3 to 6 months beforehand. Let's craft a game plan. Let's understand what your options are. Let's educate you on what the future looks like for you as far as health insurance goes. Let's start plugging some real numbers into your financial plan and start forecasting those out long term. It's not something we are doing, but we're getting the advisor back that information so they can do that alongside their client. So we would say, start that conversation once you have a firm retirement date. Start the healthcare planning conversation 3 to 6 months in advance. Now, that doesn't mean that if someone comes to us and says, I'm retiring in 2026, I'd like to know what my options are. We can always put someone at ease and say, hey, listen, you're good. You've got some options here. Here are the options. Here's what costs may look like. But starting that conversation 3 to 6 months beforehand is usually the best way to start it.
Okay, yeah, that's super helpful to know. All right, quick recap. From your point of view, what were the main things that we covered today? That if nothing else, you hope that they can take this out of the podcast. What would those things be?
For sure. This is like I feel a lot of pressure with this question, but I'll do my best to recap it. I think from my perspective, the things that you would want to be most thoughtful around when it comes to takeaways and things like that are, one, don't let health insurance be the reason you don't retire early. Whatever early retirement is for you. We see it too often where people have delayed or postponed retirement, and then we talk with them and they're like, actually, I'm going to move my retirement date up. We've seen our record to this date is 2.5 years where we've seen someone move their retirement date up because of healthcare planning. But don't let health insurance be the reason that you aren't retiring early. Whatever early means to you. That could be FIRE. That could be 55. That could be 64. Whatever it is. Don't let health insurance be the reason you don't retire early. I think the other one is health insurance doesn't need to be crazy expensive. We talked about how you can work income strategies with an advisor or even yourself if you're savvy. to make your health insurance less expensive. And I think the other big takeaway is that, you have options. Right, there are options that are available to you that you can explore with someone, whether that be a broker or exploring on your own, whatever that might be. And then, beyond just that, with those options, if you have a pre-existing condition, we drive this one home hard because a lot of people still believe this. If you've got a pre-existing condition, you can get health insurance coverage that will cover that pre-existing condition. It's not going to be excluded. You're not going to be rated up. You're not going to be denied because of it. Health insurance can still be affordable. You can still work it into your retirement plan. You can still retire early, and kind of maximize on life, as we talked about, because had it been that my father-in-law didn't know me and took his advisor's advice and information at face value, he wouldn't be retired today, and that's real. Wow. And so as I think about it, I'm like, man, he is getting so much return on investment right now. He's retired, he's getting to spend. He took my son to the library today, and they were playing cards and reading books at the library today. He wouldn't have done that. He would have been still working, right, without healthcare planning. So that's just personal to me, but you see it every single day. We see it every single day here with people that are in the same boat. So those would be my takeaways. You've got options. Don't let it be a reason to keep you from retiring, and it doesn't have to be crazy expensive. So
I love it. Those are great takeaways. And in recap, are there any other, if somebody wanted to learn more or go deeper, are there any resources that you would recommend that are credible that we can include in the show notes?
Yeah, of course. There's a couple good options. This, once again, I always promise when I do these types of podcasts and things that it's not an infomercial for what we do is Move Health, but our team lives in this wheelhouse, right? This is exactly what we do, working with financial advisors and clients on kind of that intersection of health and wealth, if you will. It sounds kind of cheesy, but that's where we work, that's where we live, that's what we do. Those are the types of problems or situations that we really love engaging in, is helping people to figure out how to unlock their next move in life, whatever that is. And so our name is very intentional. So that's an option. Connect with us. We're happy to do so. MoveHealthPartners.com. That'll probably be in the show notes, I would assume. But there's a couple other great options. Some of the details that we talked about as far as that Nationwide Retirement Institute survey, I'll send that over your way, Thomas, so you have it. And then Kaiser Family Foundation, KFF.org, is another great place to go and research all things as far as how people access health insurance coverage across the U.S. Things to look out for. They've even got a quick cost estimator that you can get those high level ballpark numbers within. It's a good place to stay in line with real updates. The other thing is like health insurance, Medicare, those things, if you're asking your friends about them, they come with a high degree of personal bias, right? So take it with a grain of salt when you're talking to someone, that is on it or has only had a small experience with it. But from our experience, with Move Health, we do this all day, every day. We've seen all kinds of scenarios. Kaiser Family Foundation is a great place to go as well that has some, academic resources, things along those lines too.
No, and I'm actually okay with this being an infomercial for Move Health because what you guys do is so unique. I've been doing this for years, and you're the first company that I've come across that has this niche focus, and it definitely fills a gap in the planning community, bridging the planning and the healthcare planning to have a better outcome for our clients. Yep. So please have no hesitation. If you want to know more, get to their website, schedule a consultation. I'm sure that they'll help you and take care with your best interests in mind. Awesome. So Cole, thank you so much.
Yeah.
Guys, I can attest that Cole is a patient, caring man. We had a lot of technology struggles getting to this point. And from me personally, just very grateful that you took this time, share your expertise. I know it's super helpful. And with that, let's call it a wrap.
All right. Thanks. It was awesome getting to connect with you, Thomas.
As we wrap up, remember that your financial match point is within reach. Connect with me at retiredtoteleco.com for personalized guidance and additional resources. If you found value today, don't forget to subscribe and leave a review on your favorite podcast platform. Thanks for listening. This podcast is for informational purposes only and does not provide financial, tax, or legal advice. Each individual should consult with their dedicated financial planner, tax preparer, estate attorney, etc. before making any financial decisions.